Investing in real estate can be a great investment for those willing to set forth the effort to acquire a profitable property. Cash flow, property appreciation, mortgage paydown, and tax advantages all make rental properties a great option for those looking to invest. Unfortunately, real estate is an extremely high barrier to entry investment, meaning you'll likely need to have quite a bit of money to get started. Don't forget the possibility for late-night phone calls and deadbeat tenants who refuse to pay their rent. For people who would rather not deal with these headaches entailed with renting out a property, you might consider a way that you can invest in real estate with less than $100 from the comfort of your own home. Real estate investment trusts, or REITs, could provide you the ability to profit from property without owning it personally. If you enjoy this content, be sure to like the video and subscribe to the channel. The majority of real estate investment trusts, or REITs, are companies that own, and in most cases operate income-producing real estate. There are many different types of REITs that own many different types of real estate, such as residential real estate, commercial buildings like office and apartment buildings, warehouses, hospitals, shopping centers, hotels, and so on. Publicly traded REITs can be bought and sold by anyone on the stock exchange, and they offer some of the benefits of owning real estate without the headaches associated with personally owning and managing property. Due to the fact that there are so many different types of REITs, it's important to choose one that aligns with your investing principles. For example, retail REITs might be finding it hard to continually grow as retail demand decreases. In contrast, it's possible healthcare could be thriving. The second major type of REIT is a mortgage REIT, which provides financing for income-producing real estate by purchasing loans from banks or originating mortgages in mortgage-backed securities. These companies make money off the payments and interest of the mortgages, instead of investing in property themselves. Some mortgage REITs focus on residential mortgages and mortgage-backed securities, while others focus on commercial mortgages and mortgage-backed securities. There are also mortgage REITs that hold both residential and commercial mortgages. Instead of buying a company that invests in real estate and compensates the shareholders with the income derived from rent checks, you'd be buying a company that profits from the financing of real estate. What makes these investments unique and different from other publicly held companies is that REITs are required to distribute at least 90% of their taxable income in the form of dividends. This is due to the business structure and IRS requirements, which allows them to not pay tax at the corporate level, but instead the shareholders will be paying tax on the income received. Investors looking for income or cash flow can benefit from the dividend payments, which are usually paid out quarterly. Some companies pay out monthly, but those are much less popular. Due to the fact that much of the income is distributed to shareholders, it's unlikely that you'd see substantial growth in terms of share price. Annual dividend yields from REITs are usually much higher than that of corporations, with some paying 10% or more per year. When choosing a REIT that will fit the needs of your portfolio, it's important to purchase a company that invests in an asset that you think will be profitable in the future. For example, with retail demand decreasing, you might choose to buy a REIT that invests in new homes or hospitals, or something that can be viable down the road. Also worth considering is the volatility of the category of which the company is invested. For example, companies investing in new real estate might be subject to more ups and downs than a company collecting rent from hotels or hospitals. Choosing a REIT is very similar to buying a stock in that you'll want to make sure the fundamentals and future prospects of the company are likely to be profitable. If you'd rather not spend the time and effort selecting an individual company and you prefer to just purchase funds, there are real estate investment trust index funds and ETFs available through Vanguard and other companies. Purchasing a REIT is as simple as buying an individual stock or ETF. You can do this with free brokerages like Robinhood or within your IRA. Keep in mind that dividends might be taxed differently than capital gains, so you might choose to invest within a tax-advantageous account. REITs may be a less volatile asset in which to park your money during a rocky economy, as other investors seek high-yielding investments with high dividends to wait out any market fluctuations. Some types of REITs also tend to perform well when interest rates are low, as it allows them to finance new property for a lower cost. Combine that with the fact that real estate has been a stable, well-performing investment in the past, and you might find that they could add value to your portfolio. Real estate investment trusts offer investors the ability to invest in real estate without the headache of owning and renting property themselves, and the ability to buy and sell shares easily and quickly. They can be a great choice for retirees seeking income in the form of dividends, or for investors looking to diversify their portfolio to decrease volatility by investing in real estate. Investing in real estate through a REIT doesn't involve a large down payment, non-paying tenants, or other disadvantages of traditional real estate investing. As a relatively stable investment, it could be a great way to build your portfolio.